งั้นป้อนมีตรงนี้ได้
สวัสดียามเช้านะคะทุกท่านวันนี้ความยินดีที่พวกเราได้รวบรวมทั้งหมดนะคะผู้นำในภาคตลาดเงินตลาดทุนก็หวังว่าคงจะไม่มีใครมาวางบอมแถวนี้นะพวกข้างหลังเราจะได้เลื่อนอันดับกันหมด So dear Thai capital market leaders, I believe many of us enjoyed yesterday from Kolkata. While Swiss central bank shock markets with currency tsunami, I think you have read all the news, especially our friends from the Bank of Thailand. They scrapped a 3-year-old cap on Swiss franc, sending this safe haven currency soaring against the euro. It's soaring as much as 30% in hectic trade and stock tumble. Any fear of the expect reliance Swiss economy over 10%, putting the stock index back to the track of their biggest one-day fall in at least 25 years. Additionally, when Wall Street started reporting its earnings for the first quarter of last year, we have seen an across-the-board beat down on trading revenues. For example, a 23% drop in bond trading from the same time last year contributed to JP Morgan's earnings miss, and sales and trading revenue at Bank of America fell year on year. Not exciting enough? The best is yet to come. France ordered French army to attack ISIS in Iraq. Britain has already sent her marine to Black Sea near Russia. Russia announced military budget increase and will shut down the gas pipeline to Ukraine to freeze Europe during this cold winter. Japan increased their military budget. ECB is preparing to print money, and experts are talking now about EU recession last night. And this is funny, George Soros, the best friend of the banks of Thai Central Bank, and probably with the British Central Bank also, he just went to Ukraine and he admitted that he was the one who paid the money, many billion US for Ukraine political chaos. He put it on some other sentence, but it means like this. And now he wants his money back. But by how, I don't know. And we really don't know what airline will crash next. Exciting enough? Comparing to that excitement, there is not much fun in Thailand right now, probably because we have already exported the protesting activity to other countries. Well, if you're worried now, please remember the quote from Jurassic Park. You know that? Life will find the way out. And now we are going to find a way out to be the financial center in ASEAN. On behalf of Federation of Thai Capital Market Organization, I would like to welcome Dr. Vikram Haksar. He is the Division Chief, IMF Strategy Policy and Review Department, to our closed-door spatial talk on financial center in Asia, and he will start first on the world economy. Have you adjust your slide because of last night's news? So please give him a big welcome. Thank you.
It's a real pleasure to be back here in beautiful Thailand, and I really want to thank very much all of you, and especially Khun Borawan, for the very kind invitation to be here this morning to speak to you. I'm just coming yesterday from Singapore, where I was speaking at a Financial Times forum on Asian financial centers, and it's an interesting perspective and an interesting time to be in Asia, a time when there is so much uncertainty and turbulence in the global economy. I'm afraid that you're going to find my presentation very boring after Khun Borawan's very entertaining start to the discussion. But what can I say? I'm a good international civil servant, so I'm not allowed to be too interested. But hopefully, I'll be able to share with you some perspectives from our side. So the thought that I had was speaking with colleagues here that maybe I'd spend some time talking to you about the world economic outlook and how we see the current situation. Maybe take a break then and take some time for questions, and then we can continue with the discussion on Asian financial centers, if that's all right. And please, I have a bad habit of speaking too fast. So if you find that I'm speaking too fast, if someone could just wave at me and I will try to slow down and speak a little bit more clearly. Sorry?
He raised his hand.
Okay, let's see. So, I'm going to talk to you today, the presentation that I'll be sharing with you today is based on the World Economic Outlook that was released in the fall of last year. As you can imagine, there have been a lot of developments in the last quarter of 2014 as well, so I will try to mix into my discussion today some of the more recent things that have happened as we speak. But I just want to stress to you that all the numbers that I'll be showing you this morning are going to be numbers as of the October World Economic Outlook that was released in Washington, D.C. at the time of our annual meetings. So the main themes that we have been making from our World Economic Outlook, a second when I can pull this out here, are on dealing still with crisis legacies. And I think this is a focus very much on the challenges facing advanced economies still, and I'll present you some facts here. I think one sub-theme that you will see is the concern that we have is that the global economic recovery is becoming increasingly unbalanced. You see a very sharp recovery in the United States after some scary news in the first part of last year. You see a very strong appreciation of the dollar as well, this time against the euro and the yen as well. You see very large divergences in monetary policy across the major reserve currency areas. This is a situation that we haven't seen for quite some time now, and it's an interesting time to be thinking about economic policy as well. But that's one theme that I will try to come back to as the discussion goes on. But clearly, dealing with crisis legacies is still something that, 8 years after the crisis, we're still not over it, and that's a feature of these kind of crises. I think another challenge that we have been thinking a great deal about are these so-called clouds. The idea that we thought that there was a rate of growth that economies, advanced economies, and emerging markets could achieve. We had a view before the crisis. And since the crisis, you had the crisis, you had a sharp drop, and then you had a bounce back. But the bounce back has been much, much weaker. They have been repeated. We've been serially over-optimistic about how strong the recovery globally has been. It's really quite striking, actually, if you look at the various vintages of the World Economic Outlook. And it's not just the IMF. I think this has been an issue with many other forecasters as well. And I think the question that we have is that at some point, from the economic perspective, we've got to think that we are faced with the risk of lower potential output, that the supply potential of economies may not be what we thought it was. And if we want to get back to where we were, it takes other types of measures beyond just the kind of demand support measures, easy money, etc., to get this kind of growth recovery. And I think, as Khun Buravan was mentioning, there are many uncertainties, and I'll touch on those as well. One of the things which has changed, I would say, quite substantially the implications of the World Economic Outlook in the last 3 or 4 months has been the oil market situation. So I will spend some time towards the end of the presentation talking to you a little bit about how we at the fund are thinking about oil and what it might mean for the global economy. And then there's a range of country-specific factors. There's a huge divergences now across countries. Every country has its own story. It's becoming increasingly hard to find single common global themes. It's really becoming very, very country and region-specific as well. So the point here is that while we have, as I said, seen a recovery, it's continuing. There have been some setbacks. In the first half of 2014, you may recall that there was some uncomfortable news in the United States. We saw some very bad prints in the first couple of quarters, bad winter, inventory adjustment. These were things which were a big surprise. The United States, as you know, in the last half of 2014 has bounced back and is growing actually at a very comfortable pace right now. And the big question in the United States is how monetary policy settings will ultimately be adjusted. When will interest rates begin to be raised, by how much? I would say that one element of uncertainty, though, facing the US outlook, two elements perhaps. One is, what is the impact of oil for the US outlook? Shale oil has been a very important part of recovery in the United States. Shale oil is not profitable at current oil prices. The other element which is really quite striking about the US is that the US recovery has in part depended quite strongly on exports, partly reflecting the weakness of the dollar, and some recovery in demand in parts of the emerging world. And that's something which we have to see how that will evolve going forward. The other news which was quite striking, of course, was the growth deceleration in Japan. We were surprised by the effects post the consumption tax increase. I don't think anybody expected the kind of pullback that took place. We were expecting some pullback, but the extent of the pullback, I think, was a surprise, and raises questions about whether we talked about the three arrows of Abenomics: fiscal policy, large monetary stimulus, and structural reforms. And maybe that third arrow is really the part that we will need to see increased focus on. And I would say that the other element, which was really quite surprising if you think back to the summer of last year, was divergent patterns even within the euro area. You know, we've been so focused for such a long time in the euro area, thinking about the periphery. We found, though, you may recall last summer, news on Germany, which was a bit of a surprise, downside on Germany growth and investment. And this is something which is an interesting theme that I will come back to giving out a little bit. And across emerging markets, I think the news has generally been quite disappointing. We have this very large experiment taking place in China right now, China trying to manage a soft landing, a gradual rebalancing, trying to gradually deflate the housing market situation out there, adjusting to a somewhat more moderate pace of growth. And managing this kind of a transition is very, very challenging, and that's something that I will again talk to you a little bit about towards the end of the presentation. And the whole geopolitical situation with the shocks that we see right now in Russia, Russia is a really striking story. The numbers that I'm showing you out here are numbers October versus April. You can see that basically we've been marking down growth. And what I can tell you is that in the upcoming update, which will be released, I believe, in the next few days, I would say that we will probably net see a further revision in global growth. And an important chunk of it really, one chunk of it is coming from Latin America, one chunk of it is coming from Russia. The Russia story is really being quite striking. Perhaps we don't think enough about the implications of Russia, both economically and geostrategically at a global level. Now, the picture on the balance of risks, this is something that economists like to constantly talk about. You ask one economist and you always get two views, on the one hand and on the other hand, right? And I think the basic sense from our side is that we still see downside risks as having increased somewhat, and there's a whole list of them out here, I think many of which I already touched on. The interesting, I would say, angle that I will spend some time talking to you, as I said earlier, about is oil and what oil might mean. We see downsides, of course, on geopolitical tensions. On financial markets, the metaphor that I think is a very powerful way of thinking of financial markets is that there's been so much monetary stimulus, there's been such pressure on asset prices. You can think of a spring that's been loaded and stretched really hard. The question is, what happens when that pressure goes and it snaps back? And we don't know how that process will unwind, and that's certainly a risk that we can see in terms of large asset price reversals and higher volatility. And I would say the other big uncertainty of the times, of course, is in terms of lower potential growth in advanced economies and in emerging markets. And the other theme that is a great preoccupation, certainly in Japan, certainly now increasingly in the euro area, is the risk of deflation as well. And that's something which I'll come back to in the discussion on oil, because it's a very, very bizarre situation where normally you think of as an oil price reduction as generally being a good thing for countries that are oil importers and energy dependent. But in a world where inflation is so low, actually it raises kind of a perverse situation in terms of having an oil price shock when inflation is particularly low. So the picture I'm painting for you is a pretty complicated one, and not a particularly optimistic one. We see recovery in the United States, which has been, I think, the question now is how much of this is policy, how much of this is just the inherent flexibility of the US economy, structural features of the US economy. But the picture is pretty mixed. So here's the view on just the overview about what needs to be done on the policy front. And I think the broad message is that from the advanced economy perspective, demand conditions still remain generally pretty weak, so there's still an argument to maintain demand support and recovery. That's a fancy way of saying that monetary conditions should probably remain easy still. It's a complicated message for emerging market countries to absorb, given the implications, of course, of capital flows and volatility, but net the argument is that it's going to be better. The other element, of course, is that we're trying to find ways to argue for advanced economies that have fiscal space to increase public spending. It's politically very hard sell in countries in the euro area, in Germany, for example. They ask themselves, why should we spend money to, we are following a perfectly prudent fiscal policy from our own national perspective. And the argument is that one way of thinking of a way of getting growth going is to focus on investment. And you'll see, I think, increasingly in the next 6 months or so, a very heavy focus on structural reforms. This is going to be, I think, a big part of the G20 discussion. I have a team right now working with me on specific structural policies that advanced economies and emerging markets could be adopting to boost growth. And I think we'll see a lot of this, I think, going forward. The basic point is that we've done a lot with macroeconomic stimulus, and there's now a real need to think about going back to basics and fundamentals of what do you do to get growth going from an investment perspective and from a productivity perspective. And I think you'll see more and more of that. And the same set of challenges, I think, applies to emerging markets. I'll show you a picture briefly about how we see some of the risks and imbalances in some of the larger emerging markets in a moment. So this picture basically shows you where we had the largest revisions to growth, the growth outlook between the earlier in 2014 and towards the end of 2014. And you can see that we had a very large revision in the US growth outlook, and this was because of the special factors that I mentioned to you, the harsh winter and the very large inventory unwind. But I think the focus now, of course, is that the US recovery in the second half of the year has turned around quite sharply. Euro area and Japan are the ones where, again, you've got two very important parts of the world where things are just not proceeding quite according to plan. On China, I think the fund outlook, and this is an outlook that's shared by many people, China really is the interesting, it's a really interesting situation right now. The baseline views that we have on China are for a gradual, the baseline is that they will succeed in achieving the gradual rebalance and achievement of a gradual reduction of the financial market excesses right now. But there are downside risks out there. So you'll see that gradually the fund's views on growth in China have been nudging downwards. Now, for those of you who follow China closely, the complexity of economic policy in China, the social objectives, the objectives of government, the need to keep growth going, to absorb labor, etc., do raise constraints. And we'll talk a little bit about those. I think the two other big drivers, which frankly, from the BRIC perspective, if you look at Brazil and you look at Russia, these are the two big drivers of the revisions to the outlook globally as well. And I think that tells you that we've got two very large emerging markets where things have not been going very well. And the view that we take is that these are really reflecting either political or structural factors, and they're not particularly conducive to monetary policy or fiscal policy supporting getting growth there. So maybe coming back to setting the stage for you a little bit also from the financial conditions perspective, this picture basically gives you an idea that financial conditions in advanced economies at least have eased generally since April 2014. I mean, you can see that, of course, there was a spike associated with the taper tantrum when the Fed said said somewhat, there was some uncertainty about what the policy path the Fed would take. Generally, these financial conditions have continued to ease. And there are many stories about what's going on out here. I heard a very interesting one from a large asset manager in Singapore yesterday. The U.S. Treasury, 10-year Treasury is down to I think 1.77%. So, and the argument was that there's, and I know many of you in the room are from the asset management side as well. The argument that this person was making was that the supply of safe assets that offer a decent return is so limited now that that's just driving this demand for any kind of safe haven gets even 1%. So sort of the fundamental driver taking place there. I think you see that, I don't have a specific slide on it, but you see that there's been this very large compression in advanced economy spreads in the Euro area, the Eurozone. I think the term that I use for this is they haven't actually done quantitative easing, they've been doing quantitative teasing so far. But it's really quite remarkable how the ECB, by sending the signal that they were going to be pursuing a quantitative easing program, which would involve some degree of government bond purchases, this has basically resulted in the markets going ahead and compressing sovereign yields quite sharply in the euro area. And now, of course, we've seen the recent judgment, at least the Advocate General for the European Court of Justice's decision, which I think is a very significant one that was released. It's being viewed, I believe, as, for those of you who are not familiar, there was a legal challenge to the outright monetary transactions policy of the ECB. Fancy way of saying that basically the ECB had set up this program to be able to provide support to countries under stress. It was a form of quantitative easing that they had basically said that they could do. And there was a challenge to this as not being a legal option for the ECB to print money in the Eurozone system. And it seems that the European Court of Justice is on the verge of making an announcement that effectively will give the ECB the full scope to pursue quantitative easing. Now we can talk about how much quantitative easing they can do, but I think, as Kunwaraman mentioned earlier, the first domino that we've seen move as a result of this, of course, is the Swiss franc. I think the authorities recognize that with a very large volume of prospective quantitative easing coming from the ECB, it was not really tenable for them to continue to accumulate assets at the rate that they had been doing previously. I think the broad pattern of financial conditions having eased was something that we saw reflected also generally across emerging markets as well, except for the last quarter of last year, where at the aggregate level, I think the story is quite varied across different emerging markets. I mean, there were massive pressures, as you know, in Russia on the verge of a currency crisis, the situation in Ukraine being not particularly great. I mean, and the stories are very, very, I would say, country-specific. In places like Mexico as well, you had, I think the oil price effect has been something that's been negative out there. In Brazil, you had a lot of stories in terms of local problems in Petrobras, other challenges that the authorities are facing. But the upshot of it is that we saw pressure again re-emerge in some emerging markets in aggregate in the fourth quarter. So it's a bit of a more mixed picture, and I think that ties in with the sense that we will continue to likely experience stresses and volatility in emerging markets in this period of large monetary policy and currency divergences across the advanced economies. So, what can we deduce about the current state of